Hey guys, and welcome back to the channel. On today's video, we're going to discuss 10 investing mistakes beginners should avoid. Hopefully this video helps prevent you from making any of these mistakes. Let's get into it. The first mistake on the list is not investing at all. Now I know you're going to say this list was mistakes made by beginner investors, so bear with me, this is the only one, all the rest are relevant to actually investing. We've been conditioned that cash and savings are key and that we should build up a nest egg and just keep it in our bank or savings account. Currently we'd be very lucky if we got an interest rate over 1%. The problem with keeping our money only in a savings account is to do with inflation. You can check out more about inflation on this video up here, but essentially it's the rate at which the cost of goods and services increase annually. And currently it's at about a rate of 2% per year. So the buying power of your money in your savings account is being devalued by 2% annually. Whilst most people think it's quite risky investing, and I do agree there is a certain amount of risk involved, however I don't think it's an extremely high risk option. I would much rather take a small risk and have my money working for me in the stock market, trying to build and generate wealth, rather than keeping my money only in a savings account, where the biggest risk is actually my money is being deteriorated by inflation. So for me, it's the risk of trying to increase money versus the risk of doing nothing and watching it go down. And that's why I'm a big advocate of trying to invest your money, even if it's only to maintain the rate of inflation. Another investing mistake made by beginners is investing before they have an emergency fund. Again, I've done a video on emergency funds, which you can check out up here. But essentially, an emergency fund keeps 3 to 6 months worth of your living expenses saved up in an account. Should you need it, you can take the money out of it. Too often you see beginner investors get caught up in the thrill of investing, thinking that they're going to be able to double their money or significantly increase it, and so they want to get in on that action first. And unfortunately, this tends to happen without them having the foundation of an emergency fund to fall back on. And this is a huge mistake. If you were to lose your job or get injured or have a medical bill, and the bill had to be paid ASAP, you'd likely have to sell your investments to cover these costs. If you were forced to sell your investments to cover this emergency, then it's going to either be you're selling an investment at a loss, in which case that's not good news, or you're going to sell an investment that's actually on a good run and maybe it's profitable for you, and that might implement you with some other tax issues, and also it prevents you from generating more money from that investment in the future. Either way, neither of these are a good option, and that's why it's critical that you don't start investing without having an emergency fund built up. Another mistake beginner investors make is not actually having an investing plan or strategy. Most successful people in life, doesn't matter what industry or what field it is that they do, have had a plan and they've followed that plan to become successful. You all work extremely hard for your money and you're choosing to put that money into investments. So it would seem crazy to me that you're going to go and invest without a plan or a strategy in place to try and maximize your gains and minimize any risk of errors occurring. Having this investing plan will enable you to be held accountable to this plan, but also stop you from feeling lost or not sure what to do. For example, you could think about a plan where you're going to invest $500 every month into a market tracking index fund or ETF for the next 30 to 40 years. Yeah, I know that's a long time, but in order to see great returns on your investment, you need to play the long game. You're more likely to invest the $500 every month if you actually have this plan written down somewhere. Otherwise, it may come to the end of the month and you see you've got $500 left over and you might want to do something else with it. Having this plan stops you from doing that, and it also prevents you from making any rash investing decisions. So before you start investing, make sure you have a plan and stick to the plan. Another mistake to avoid is forgetting to subscribe to the channel, turning on the notification bell, dropping a like or comment down below. Okay, next up on the list, and this is probably one of my favourite mistakes to avoid, is buying hot stock tips. This is one of the easiest investing mistakes or traps to fall into. A lot of these guys are great marketers. They play on your emotions and your psychology to try and get rich quick, or that they know everything and they're like the oracle of investing. And the truth is, they're not. Nobody can predict the future. Nobody can guarantee what a stock is going to do. And charging people for this knowledge or for their hot stock tip is just not on. These people selling these hot stock tips probably also have a legal disclaimer in there somewhere saying that they're not liable if what they say is going to happen doesn't happen and you lose your money. I mean, it just seems crazy. So this is just a big mistake that beginner investors can make, so just please do not do it. Picking individual companies to invest in actually takes a significant amount of time, research, effort and energy. Not to mention it carries a lot of risk. There are professional fund managers that literally it's their full-time job to try and pick these companies to invest in. In actual fact, 92% of these professional fund managers actually get beaten by the market performance over a 15-year period. So that means only 8% of professional fund managers in the world outperform the market. And I highly doubt this 8% of fund managers are offering up hot stock tips because they're getting paid a lot of money to do it for the companies that they run. So please don't fall for the mistake of buying hot stock tips. Do your own research or keep it simple and just invest that money into the market tracking, index fund or ETF. The next mistake on the list to avoid is trying to time the market. As I said previously, nobody can predict the future, so therefore it's near impossible to predict when the best time to enter the market is or to exit your position. That's not to say that you can't take advantage of big opportunities when they present themselves, such as the most recent crash and pretty swift recovery. If your investing strategy is to continuously try and time your entry and exits into the market, then it's probably going to end up pretty bad for you. At some point in time, even if you're on a roll, you're going to make a mistake and you're going to miss time an exit or an entry point and wipe out all the gains that you've made. The single greatest asset you have when investing is the time that you spend in the market. The longer you have your money invested in the market, the greater the opportunity for compounding growth to occur, as well as giving your investments the opportunity to weather any storm or fallout from market crashes. For example, this most recent crash will probably just be a blip on the radar in 30 years' time. So don't try and time the market and try and get as much time in the market as you possibly can. Another common investing mistake that's made by beginners is FOMO investing. FOMO investing is the fear of missing out. You're afraid that you're going to miss out on the next big thing, the next Amazon or the next Apple. This causes you to invest in things with emotions or hype rather than based on fundamental or valuation methods. Usually FOMO investing occurs when there's a lot of hype about a company. For example, the upcoming Apple and Tesla stock splits is driving the price through the roof. Everyone's going crazy for it. At some point though, reality will catch up to FOMO investing and cause stock to crash or pull back significantly. A perfect example of this is Bitcoin. In 2017, when not too many people had heard about it, it was around about $1,000. Then the media train came rolling in, hyped up Bitcoin like crazy, and it jumped up to $20,000 in the middle of 2018. And then by the end of 2018, when the hype had all settled, it had crashed back down to $3,000. This not only burnt a lot of people, in some cases absolutely destroyed people's lives because they got bought into this FOMO investing hype and then ended up being left with nothing. FOMO investing is a bit like playing a game of musical chairs. It's all fun and games whilst the music's playing, but when it stops, you better have a chair to sit down on, otherwise you're falling pretty hard. So please don't get caught up in FOMO investing. Another mistake to avoid is paying fees. I hate paying fees for most things, but especially when I'm investing. You're trying to do the right thing by getting your money working for you and building it up, and then there's fees involved, deteriorating your gains. Nowadays, there's no real reason to be paying any fees when trading. There's a lot of new brokerage accounts out there that enable this fee-free trading option. As I've mentioned before, the simplest and probably best investing strategy is to get a market tracking index fund or ETF. These index funds and ETFs, however, are not all made the same. And that's why it's really important to compare the fees of each fund or ETF. It's best to look at their fees and expense ratios. Realistically, you shouldn't be paying any more than 0.5% in your fees for an index fund or an ETF. I think Vanguard offers up a fund that charges 0.15% management fee, which is extremely low, and therefore giving you more money to invest and compound over time. Make sure you do yourself a favour and check over the fees that you're being charged, as it will benefit you significantly in the long run. Another investing mistake to avoid is chasing high dividend yields. Dividends are essentially a thank you from a company to its investors. They usually pay it to their investors out of the profits of their company, but they are not required to do so. As an investor, when you first learn about dividends and get your first dividend payment in your account, it's a pretty amazing feeling, generating passive income from a company that you believe in and expect to do well. The dividend yield is calculated by taking the annual lump sum dividend payment and dividing it by the price of the stock. Generally speaking, high dividend yields are 10% plus. The issue is, to have a high yield like that, often it means the stock price has come crashing down in relation to the dividend payment. What this means is that the company may not be able to afford to keep paying that dividend. So if you're only investing in the company because it has a high dividend yield, then if they have to stop paying the dividend or decrease it significantly, then you just got caught in a dividend yield trap. Essentially, you've gone looking for high yield and you haven't checked out the fundamentals of the company, and you've been left with a dud of an investment. So don't go chasing high dividend yields. Next mistake to avoid is letting your emotions control your investing decisions. All too often, you see people freaking out about their investment decreasing significantly in value and then selling this stock at a huge loss, only to see 2 or 3 weeks later that the investment is not only worth the same, if not even more than what it was when they initially had it. Investing really should be like watching paint dry, absolutely boring, but with the added bonus of you building significant wealth. Emotions truly are your worst enemy when it comes to investing. You really need to learn to get them in check to do well as an investor. A good way to stop your emotions getting the best of you is to set up an automatic investment payment into your brokerage account. This way it'll get done automatically for you, and you won't physically have to open up the account and see what's going on. If you're not seeing the fluctuations in the price of your investments, that should help control your worry or excitement over how your portfolio is doing. Investing in penny stocks is a huge mistake and can produce catastrophic results to your long-term wealth. Often people want to invest in penny stocks because they think a $4 stock is much more likely to double or triple in value than a $100 stock. Penny stocks are stocks that are generally priced under $5 on the stock exchange, and they're extremely volatile companies. Try and think about pharmaceutical companies that are just ticking along at $2 or $3. All of a sudden, they get FDA approval, their drug goes on the market, and then they triple in value. So, extremely volatile situation, and that's kind of what penny stocks are. It's the extreme volatility of penny stocks that makes them very dangerous and a big no for beginner investors. Do yourself a favour, don't go anywhere near penny stocks, and instead invest in a market tracking ETF or index fund. And those are the 10 investing mistakes that beginners should avoid. I hope you got some value out of this video. Please don't make any of these investing mistakes. If you enjoyed it, share with family and friends, and I'll see you next time.